Welcome everyone. Today we are going to talk about mutual fund operations, specifically within the Malaysian context where the industry uses the term unit trusts. This is not a sales pitch for any fund. What we are doing here is opening up the machine and looking at how it actually works. We will cover the operating mechanics of how money flows in and out of a fund, how pricing is determined every single day, the governance architecture that protects your money from the people managing it, the different asset classes available through fund structures, and the frictional costs that silently erode returns over time. By the end of this session, you should be able to evaluate any fund placed in front of you, not based on marketing material but based on structural understanding. Let us begin. The foundational problem that mutual funds solve is simple. If you have 5,000 ringgit or even 50,000 ringgit, you cannot build a properly diversified portfolio on your own. To hold 50 to 100 different securities across equities, bonds, and money market instruments, you would need hundreds of thousands of ringgit at minimum, plus the time and expertise to manage it all. This is the individual barrier. Small investors lack the capital to independently construct institutional quality portfolios. The mutual fund solution is elegant. By pooling money from thousands of investors into a single vehicle, each investor effectively buys a proportional slice of a much larger, professionally managed portfolio. Your 5,000 ringgit gets you the same diversification and professional management that a pension fund or insurance company would access. The third element shown here is the open-end mechanism, which is critical to understand. Unlike a company that issues a fixed number of shares, an open-end unit trust continuously creates new units when investors put money in and cancels units when investors take money out. The fund expands and contracts to match demand. This is the dominant structure in Malaysia, and it means your units are always redeemable directly from the fund itself. You are never stuck trying to find a buyer on the secondary market. Before we dive into the mechanics, I want to step back and explain why mutual funds matter beyond personal wealth creation. They serve a structural economic purpose. Think about what happens when millions of Malaysians place their savings into unit trusts. That capital does not sit idle. Fund managers channel it into equities, which means companies receive the capital they need to expand operations, hire workers, and build infrastructure. They channel it into bonds and sukuk, which means the government and corporations can finance large-scale projects. The returns, dividends, and interest generated by these investments then flow back to the households that provided the savings in the first place. This is a virtuous cycle. Household savings flow into mutual funds, which inject capital into the productive economy, which generates corporate expansion and infrastructure development, which creates returns and employment that flow back to those same households. Mutual funds are not just a personal finance tool. They are a critical conduit in the macroeconomic plumbing of the country, channeling dormant savings into productive, investable projects. Now let us ground ourselves in the actual numbers. As of December 2025, according to Securities Commission Malaysia data, the Malaysian unit trust industry holds a total net asset value of 580.17 billion ringgit. Of that, conventional funds account for 448.11 billion and Sharia-compliant funds account for 132.07 billion. There are 27.3 million unit holder accounts in the system. To put that in perspective, Malaysia's population is roughly 34 million. That number of accounts does not mean 27 million unique individuals since one person can hold multiple accounts, but it gives you a sense of how deeply embedded unit trusts are in Malaysian financial life. There are 767 active launched funds in the market, overseen by 39 approved management companies. And the industry's NAV represents 28.1% of Bursa Malaysia's total market capitalization. That is a significant share of the nation's equity market effectively held through pooled investment vehicles. The timeline at the bottom traces how we got here. Malaysia was an early adopter in Southeast Asia. Malayan Unit Trust Ltd was established in 1959 as the country's first unit trust company. The industry's defining moment came in 1981 when Permodalan Nasional Berhad launched Amanah Saham Nasional, which transformed unit trusts from a niche product into a household name. By 2024, the broader investment management industry's assets under management crossed the 1 trillion ringgit mark for the first time. The entire ecosystem is governed by SC Malaysia guidelines and distributed through banks, online platforms, and FIMM-registered consultants. This slide explains the single most important number in mutual fund investing, net asset value or NAV. The formula is straightforward. Take the total market value of everything the fund holds, subtract any liabilities the fund owes, and divide by the total number of units outstanding. The result is the NAV per unit. This is the price at which you buy and sell. Two important Malaysian context points here. First, retail unit trust funds in Malaysia operate on forward pricing. This means when you submit a purchase or redemption order today, the transaction does not execute at today's NAV. It executes at the next computed NAV, typically calculated at the end of the business day. You are always transacting at a price that has not yet been determined at the moment you place your order. This prevents the kind of stale price arbitrage that could disadvantage other unit holders. Second, and this is something many retail investors misunderstand, the distribution illusion. When a fund pays an income distribution, the NAV drops by exactly the amount distributed on the X date. If a fund with a NAV of 1 ringgit distributes 5 sen, the NAV falls to 95 senator. Your total wealth has not changed. You just moved 5 sen from inside the fund to your pocket. It is a payout of existing value, not free money. This is critical to understand because some investors chase high distribution funds thinking they are getting something extra, when in reality the distribution is simply a reconfiguration of what they already own. When you invest in a fund, your returns can come through 3 distinct channels, and understanding this breakdown matters for evaluating performance properly. Channel 1 is income. This is the stream of dividends the fund receives from equities it holds, and coupon payments from bonds or sukuk in its portfolio. These are cash flows generated by the underlying investments. Channel 2 is realized gains. When the portfolio manager decides to sell a holding that has appreciated in value, the profit is locked in. The difference between the purchase price and the sale price becomes a realized capital gain within the fund. Channel 3 is unrealized gains. These are paper profits on assets the fund still holds. The stock went up, the bond price rose, but the manager has not sold yet. These gains are reflected in the NAV but have not been crystallized. Total return after fees encompasses all 3 channels combined, minus the drag of ongoing expenses. And here is the key warning at the bottom of the slide. High distribution payouts do not automatically equate to high performance. A fund may distribute heavily simply by returning your own capital back to you. That would show up as a generous distribution while the NAV steadily declines. The only metric that accurately reflects true wealth creation is total return, which captures income, realized gains, and unrealized gains together, minus fees. This is one of the most important slides in the entire presentation because it addresses the question every investor should ask. What stops the fund manager from running away with my money? The answer is structural separation of powers. Look at the architecture. At the core sit the fund assets. Surrounding them is the trustee or custodian, an independent institution, typically a bank or a specialized trustee company, that physically holds all the assets on behalf of unit holders. The portfolio manager makes investment decisions deciding what to buy and sell, but is completely blocked by the trustee shield from ever having direct access to the cash or securities. On the other side, the compliance and oversight board monitors the manager to ensure every decision stays within the fund's mandate. If the prospectus says the fund invests in Malaysian equities, the manager cannot suddenly put money into US tech stocks or cryptocurrency. For Islamic funds, there is an additional layer. The Sharia Committee, which screens all allowable assets before investment directives can reach the core portfolio. This ensures ongoing compliance with Sharia principles. The bottom line statement on this slide is critical. This separation of powers is the ultimate safeguard. Even if the fund management company itself faces corporate insolvency, your assets remain isolated and protected in the vault of the independent trustee. The management company's creditors cannot touch the fund's assets. This is the structural advantage of the trust framework. Now we turn to costs, which many investors underestimate or overlook entirely. There are 2 categories of friction. On the left, entry and exit friction. The sales charge or front-end load is paid upon purchase. Historically, this was quite high in Malaysia, but competition and digital platforms have driven it down significantly. FIM's research shows the average sales charge for equity funds dropped from 3.1% in 2014 to approximately 1.9% by 2020 for cash purchases. That is a meaningful decline. The redemption fee or back-end load, paid when you sell, is increasingly rare on modern platforms. On the right, the ongoing drag. This is what really matters for long-term investors because it compounds against you every single day. The management fee compensates the portfolio manager, analysts, and research team. The trustee and custody fee pays for the independent safeguarding of assets. And administration covers the mechanics of record-keeping, daily pricing computations, and regulatory reporting. The key insight here is that while the entry friction is a one-time hurdle you can see and feel, the ongoing operational drag is invisible. It silently shaves fractions of a % off your NAV every day, and over decades, the cumulative impact is enormous. That brings us to the next slide. This is the slide I want everyone to remember long after this presentation is over. Here is a simple scenario. You invest 10,000 ringgit with a gross market return assumption of 9% annually over 20 years. Fund A charges 0.5% in ongoing fees, giving you a net return of 8.5%. Fund B charges 1.5%, giving you a net return of 7.5%. Just 1 percentage point difference in fees. After 20 years, Fund A grows to approximately 51,000 ringgit. Fund B grows to approximately 42,500 ringgit. The gap is 8,500 ringgit. That is 8,500 ringgit of wealth destruction caused by a mere 1% fee difference on an initial investment of just 10,000. And this scales linearly. If your starting capital were 100,000, the gap would be 85,000 ringgit. I have verified this math. At 8.5% compounded annually for 20 years, 10,000 becomes 51,120. At 7.5%, it becomes 42,479. The rounded figures on the slide are accurate. The message at the bottom captures it perfectly. Fees are entirely predictable while market returns are not. When evaluating two funds with identical asset exposure, minimizing the total expense ratio is the single most controllable lever you have for long-term wealth compounding. You cannot control the market. You can control what you pay. Now we shift from mechanics and costs to the actual building blocks available to investors. This slide maps out the classic risk-return spectrum. At the bottom left, money market funds. These invest in very short-term instruments like treasury bills and overnight deposits. Volatility is near zero, but so is the return premium over inflation. Think of this as a parking spot for cash, not a wealth-building engine. Moving up, fixed income and sukuk funds. These generate income through Malaysian government securities, corporate bonds, and sukuk. They offer higher returns than money market but introduce duration risk, meaning their NAV moves inversely to interest rate changes. In the middle, balanced and hybrid funds. These blend equities and fixed income in a single portfolio, often with a target date lifecycle approach that gradually shifts from aggressive to conservative as the investor ages. At the top right, equity funds. These invest in corporate shares and offer the highest expected return over the long term but come with the highest volatility. Your NAV can drop 20 or 30% in a bad year. The sidebar makes the important point. No single fund structure solves every financial problem. Each asset class is a different engine type engineered for a specific phase of the wealth-building lifecycle. Diversifying across these classes prevents your entire portfolio from reacting to the same market shocks simultaneously. Diving deeper into equity funds specifically, the slide explains that equity performance is driven by three forces: broad market momentum, which is your beta exposure, localized sector cycles, and the portfolio manager's skill in selecting individual securities. The four quadrants on the left show the main equity fund mandates. Growth mandates target companies with rapid expansion potential but exhibit higher beta and larger valuation swings. Dividend and income funds focus on mature companies yielding regular cash payouts, which provide a downside cushion during market declines. Global and international funds access markets like the US, China, or ASEAN, but introduce currency risk through ringgit to foreign currency movements. And thematic and sector funds are hyper-focused on specific industries like Malaysian plantations, technology, or financials. On the right is a feature unique to the Malaysian context: the Sharia filter. The Securities Commission's Sharia Advisory Council screens the entire Bursa universe and explicitly removes sectors that are non-compliant, such as conventional banking, gaming, alcohol, and tobacco. This creates a structurally different investment universe. A Sharia equity fund's return profile will diverge from broad conventional indices like the FBM KLCI because the underlying stock pool is fundamentally different. This is not a flaw. It is a design feature that investors need to understand and account for when benchmarking performance. Fixed income and sukuk funds serve a specific role in the portfolio. They act as the counterweight to equity volatility. The mechanical inverse on the left explains the key relationship. When Bank Negara Malaysia raises the overnight policy rate, newly issued bonds offer higher yields. This makes existing bonds with lower coupon rates less attractive, so their prices fall. This is duration risk or interest rate risk. For bond fund investors, an OPR hike means a temporary dip in NAV. However, the higher rates also mean the fund can reinvest maturing holdings at better yields going forward, so it is not purely negative. The seesaw visual in the center captures this inverse relationship between risk-free yields and bond NAV prices. On the right, the domestic backbone. Sukuk forms the core of Malaysia's Islamic capital market, which is one of the largest in the world. Portfolios range from ultra-safe Malaysian government securities, which carry sovereign credit quality, to higher-yielding corporate sukuk, which introduce credit spread and default risks. Understanding where a bond fund sits on this spectrum is essential. A fund investing heavily in corporate sukuk will behave very differently from one concentrated in government paper, even though both fall under the same fixed income category. This slide carries a deliberate warning banner for good reason. Money market funds are often treated by retail investors as if they are bank deposits. They are not. The purpose is clear: engineered for minimal volatility and capital preservation. They are ideal for corporate treasurers parking surplus cash or retail investors holding funds temporarily between investments. The hidden mechanics involve pooling capital to purchase very short-dated institutional paper, including treasury bills, commercial paper, and repurchase agreements. Because the maturities are so short, interest rate risk is kept near zero. But these are still market instruments, not bank deposits. The distinction on the right is the critical point. This is an investment product subject to credit events. If a money market fund holds a significant amount of commercial paper from a single corporate issuer and that issuer defaults, the fund's NAV will take a hit. This concentration risk does not exist when you hold government bills. And the red banner says it plainly: not PIDM insured. Unlike your bank savings account or fixed deposit, which is protected up to 250,000 ringgit by PIDM, money market fund investments carry no deposit insurance whatsoever. If the fund loses value, that loss is yours. This distinction matters enormously and is frequently misunderstood by retail investors. This slide introduces two structural innovations that simplify investing for people who do not want to make active allocation decisions. The target date fund concept is shown across the three dials. At age 30, in the aggressive phase, the allocation might be 80% equities and 20% bonds. Maximum growth exposure because you have decades before retirement. At age 45, the moderate phase, this shifts to 60% equities and 40% bonds. Still growth-oriented but with increasing stability. By age 60, the conservative phase, the allocation has glided to 30% equities and 70% bonds and cash. Capital preservation becomes the priority because you are approaching or entering drawdown. This glide path happens automatically. The investor does not need to manually rebalance. The fund structure does it for them according to a predetermined schedule. Malaysia has formalized this through the Private Retirement Scheme Framework. PRS had a NAV of 7.61 billion ringgit as of 2024, growing 18% year-on-year. These schemes heavily utilize target date multi-fund portfolios to automatically de-risk as members approach retirement age. The second innovation is index tracking. For investors who want pure, low-cost market exposure without active manager risk, Index funds and ETFs mirror benchmarks like the S&P 500 or the FBM/KLCI rather than attempting to beat them. This eliminates stock selection risk and typically comes with much lower fees. This comparison table is something every investor should have in their toolkit. It maps the structural differences across the three main fund types. Open-end funds, which are what unit trusts are, have infinite unit supply. Units are created and canceled on demand. Pricing is at end-of-day NAV through forward pricing. You transact directly with the fund or its agent, and liquidity comes from the fund's own internal cash reserves. This is the dominant structure in Malaysia, representing the vast majority of the industry's 580 billion ringgit in NAV. Closed-end funds have a fixed supply set at launch. They trade on a secondary exchange at market prices, which means they can trade at a premium or discount to NAV. Your liquidity depends entirely on finding another buyer in the market. If nobody wants to buy your units, you are stuck. Exchange-traded funds sit in between. Their supply is dynamic, managed through a creation and redemption mechanism involving authorized participants. They trade at intraday market prices on Bursa Malaysia, and their prices closely track NAV because authorized participants arbitrage any significant deviations. The ABF Malaysia Bond Index Fund, launched in 2005, was Malaysia's first ETF. The key takeaway is that the structure you choose determines not just your return profile, but your ability to access your money when you need it. Beyond traditional fund structures, there are alternative investment vehicles that operate on fundamentally different principles. Real estate investment trusts, or REITs, represent ownership in physical properties like shopping malls, hospitals, and logistics warehouses listed on Bursa. They generate returns through rental income and property appreciation. But they are highly sensitive to interest rate movements, occupancy rates, and refinancing costs. When BNM raises rates, REIT prices tend to fall because their borrowing costs increase and their yield becomes less attractive relative to risk-free rates. Hedge funds utilize advanced strategies including short selling, leverage, and derivatives to isolate returns that are uncorrelated with traditional markets. In Malaysia, these require sophisticated investor eligibility and impose strict lockup periods where you cannot access your capital. Private equity and venture capital target multi-year illiquidity by design. Capital is locked for extended periods while the fund managers take operational control of companies, restructure them, and aim for concentrated exit events like IPOs or trade sales. This is not about daily pricing. It is about building value over years and realizing it in large, lumpy payouts. The bottom line message: alternatives are not inherently smarter investments. They trade the liquidity and transparency you get with traditional funds for structural flexibility. That trade-off may or may not suit your circumstances. This is an uncomfortable slide for many in the fund management industry, but the evidence is clear and your students deserve to hear it. The trap, shown in the top right box. Fund ratings and performance rankings are inherently backward-looking. They tell you which managers did well in the past. But statistically, extreme recent outperformance rarely persists once market cycles rotate. The hot fund of the last 3 years is often the mediocre fund of the next 3. Investors who chase last year's top performer are systematically buying after the peak. The chart on the left illustrates this visually. Fund performance follows something like a bell curve life cycle. Investor capital tends to pile in at the peak, right when the fund appears most impressive. Then the friction zone hits. Mean reversion pulls returns back toward the market average, and compounded fees grind away at whatever excess return might have existed. The reality in the middle box: academic consensus across decades of research demonstrates that after subtracting operational fees, the majority of actively managed funds fail to beat their benchmarks over long horizons. This does not mean active management is worthless. It means the odds are structurally stacked against the average active fund. The shift at the bottom is the practical takeaway. Wealth generation requires moving focus away from return chasing and toward the controllable elements, which are cost minimization, proper risk alignment with your actual time horizon, and disciplined asset allocation. I want to close with something practical. Rather than telling you which fund to buy, I am giving you a 5-step diagnostic framework that you can apply to evaluate any fund placed in front of you. Step 1. Mandate alignment. Does the stated objective of the fund, whether it is capital growth or capital preservation, mathematically match your actual investment horizon? If you need the money in 2 years, an aggressive equity fund is structurally wrong regardless of how good its past performance looks. Step 2. Total friction. Compare the total expense ratio and sales charge against exact peer equivalents, not against a different category. Compare equity fund fees against other equity funds, bond against bond. This is where the invisible drag we discussed earlier gets exposed. Step 3. Risk architecture. Look beyond the fund name. What is the true internal asset mix? What is the credit quality of the bonds held? How much of the portfolio is exposed to ringgit versus foreign currencies? A fund called Malaysian Balanced might have 30% in US dollar assets, which introduces currency risk that the name does not reveal. Step 4. Liquidity profile. Are there structural gates, extended settlement days, or lockup periods that could prevent you from accessing your capital when you need it? This matters especially for alternative funds and certain fixed income vehicles. Step 5. Governance layer. Who acts as the independent trustee? For Islamic funds, who provides Sharia oversight? These are the structural safeguards we discussed in slide 7. Verify that they are in place. And finally, the verification authorities box on the right. Before deploying any capital, verify prospectuses, disclosures, and consultant registrations through SC Malaysia at sc.com.my and FIMM at fmm.com.my. These are your primary checkpoints. Thank you for your attention. I welcome your questions.